So what does all of this mean potentially for a deal that could certainly move the markets, as I've like to remind you, nothing, at least to my memory in this whole bull run through the presidency of Donald Trump, has moved the markets like the prospect for trade. If it looks like deals are there to be had, they jump. If it looks like something's going really far and awry and falling apart, they tumble. You can almost time it. To Forbes publisher Rich Karlgaard, and the guy who had signaled me about these potential promising signals on the part of China and the United States. We'll see if they pan out. Gary Kaltbaum. Gary, let me get your sense of just how important this is. You know, a lot of people gloss over it, but they want this resolved, this impasse between the world's two biggest economies, because the longer it drags on, the worse it is for both of them, right?
Yeah, and look, yesterday it's a short-term thing, but the market popped 200-300 points as soon as that news came out.
Absolutely.
And every time there's more news that maybe it's not so, the market's dropping a few hundred. I actually think something's going to get done sooner rather than later. I say that for a couple of reasons. Number one, I haven't seen Navarro on TV for the last week or two.
Peter Navarro, their trade
right,
rep,
and he's
so
the hardcore guy.
Right.
That's number one. Number two, they're all seeing now that Japan, Germany, which is the engine of Europe, both had contracting quarters. Our industrial production, much less than expected. Earnings guidance really starting to head down, not only for technology, but we're seeing it in retail. China numbers, I don't even know what numbers they are. So I think everybody knows that something better get done. And when I speak to companies, by the way, we're seeing capital spending heading down with some companies because of tariffs also. So I think all the parties know at this point, the longer this goes on, the worse it could get. And I'm pretty sure we're seeing the telegraphing of something getting done. I don't know if it's going to be big, but just anything or something to move the needle and calm the waters a little bit.
Well, Rich, my view to what Gary was just saying is that trade has been dictating the course, or at least the short-term, ebbs and flows of this market. And the devil's always in the details on these trade matters. For example, we just heard from Bill Pascrell in New Jersey, who's going to have a key role in this trade subcommittee within House Ways and Means, who doesn't like what the president orchestrated with the Mexicans and the Canadians. So just the promise of talks and progress doesn't mean you have a deal. So leaving that aside, how important is it to you that the president come back with something from Argentina, the G20 summit, even if it's nothing to write home about, but it's something?
I think it would be hugely important. I think Gary hit it right, perfect bullseye, that Peter Navarro has been the bad actor here. Now, why this failed politician, failed mayoral candidate, socialist professor from a University of California campus got to where he was to have President Trump's ear, I will never know. But the fact that he went off the rails and talked about the stench of Goldman Sachs, it's about time this clown has been sidelined. And so I think,
I think
all of this is good.
It just seems to me you both hate Italians in power. And the Peter Navarro thing seems like a very unfair rough. But I digress. Let me get your attention, guys, with what's been happening on the Treasury yield front. I just had this darn thing up here, so if you'll indulge me. We've been watching the Treasury closely because what goes out of stocks presumably goes into Treasuries. And, Gary, right now we're at 3.08%, which is a two-week low. And I'm wondering what's going on with that and what you as an investor are to make and do with that.
It's indicative of money coming out of markets and finding a place to park itself riskless. And when you have them in the threes, when it used to be in the twos, it's easier to go and buy these things. And that's definitely what's going on. But I must tell you, Neil, the one area of the market that I'm watching most closely when we're talking the income market is General Electric.
Oh, yeah.
If that blows up, if they start going into junk bond land, that can really roil the credit markets, and that will affect the stock markets also. So we're going to be watching that very closely over the next few weeks, because we're just finding out what kind of leverage this company put themselves into over the years. So going to be very important. But leave no doubt, there's Treasury yields coming down, tells you there's a slowdown at hand, and tells you that people are getting away from risk to buy the riskless, and it's probably not the worst move right now.
Gary, I'm glad you mentioned that. And Rich, a lot of people think of GE, and I used to work at CNBC and NBC, so I feel sort of like, I don't know, a compadreship, if you will, because I can't believe what's happened to this company. But a lot of people look at all the investors scurrying away and the stock flittering away, but they lose sight of the fact that a lot of institutions are exposed to GE and GE debt, and to say nothing of how it has propped up a number of other financial transactions. So without getting too into the weeds, GE falling apart is kind of like a third world country falling apart. I don't think people appreciate the magnitude of that, do they?
You know, GE, I think we look at the tenure of Jack Welch, and in retrospect, it doesn't look so good, and he handed Jeff Immelt a pretty impossible situation. But don't forget that back in the early 90s, we said the same thing about IBM.
You're right.
And there was talk of breaking up IBM. So the thing that really matters is underlying economic growth. Everything gets worse if this country falls back to 2% growth. If we can stay at 3%
but IBM
growth.
never got this bad, my friend. You know what I mean? And IBM never got this forlorn. That doesn't mean that you know, there are other similarities there, but GE seems to be in a very special, maligned camp here.
Well, I think if you talk to Lou Gerstner, who was the CEO at the time, he will tell you that they were within weeks of declaring bankruptcy. So it was pretty dire at IBM in the early 90s.
All right. Gary, you know, you never say never, and hope springs eternal for a company like GE that is so Americana, but I always remember some of the other American staples that could never fall, even in the face of new technologies. Eastman Kodak comes to mind. We're reminded that there is no right that a company has to grandeur. And I'm wondering what's playing out here is beyond a fix, or, you know, other factors come in and save it.
Well, you know what the biggest worry is, Neil? This is all happening in a low interest rate environment and a soaring economy. So one asks the question, if we get out of a soaring economy and have a real slowdown, then what happens? And, you know, we talk about this word, and I hate using it, but contagion. There's a lot of counterparty risk in these things, a ton of the paper owned by banks and lenders and all that. So you never know what the outcome is going to be. And by the way, we're not talking about $1 billion here. We're talking about tens of billions of dollars. So that's why I wanted to bring it up when you brought up the income front. It is something that has to be looked at front and center. But the good news is the new CEO has come in. He is moving swiftly. He's trying to off some things, take down the leverage, and hope they're going to be much smaller going forward, but hopefully intact.
All right, we'll watch it closely. Gary, thank you very much. Rich, always good chatting to you. I did like the Lou Gerstner analogy there. Obviously, a lot of GE watchers are hoping that's the kind of a comparison that prevails. By the way, as both of these fine gentlemen are talking, GE stock now falling toward its lowest close since 2009.